Trading is a tough business, and most people who start in the business lose money. Indeed, Forex and CFD brokers are mandated to have a banner on their websites about the percentage of traders who lose money. While the numbers vary slightly from study to study, the fact is many traders will lose money and it can't be avoided. All sorts of reasons are given for the losses, including poor money management, bad timing, or a poor strategy. These factors do play a role in individual trading success, but there is a deeper reason why most people lose. Most traders will lose regardless of what methods they employ. Even if all traders knew how to trade successfully based on current conditions, most traders would still lose over the long run. Keep in mind, knowing and doing are two very different things. It's no surprise more than 75% of all day traders end up quitting within just 2 years. Let's explore why that is. We will look at some of the most popular reasons why more than 90% of new traders will lose their money in trading. Don't worry, in addition to explaining why so many traders, especially new ones, lose money, we'll also tell you how to avoid these traps. Reason 1. Lack of knowledge. The most common reason why many traders lose money is simply that they want to become professional traders without learning more about it first. This is mostly because many traders start trading when they see an advert talking about trading. These ads are in all platforms like YouTube, Facebook, and TikTok. In fact, many people refer to themselves as traders simply because they buy and sell shares. But when questioned about how they analyze the stocks they buy or sell, they claim they read reports in newspapers and on websites, and occasionally look at online charts with their broker. After spotting an ad and learning more about its potential, they open an account and start trading. They do all this without even learning the differences between assets and how trading works. Other people start trading after seeing the hyped stories of millionaire traders on television. Reason 2. Fear of missing out. The second most important reason why many traders fail is the fear of missing out, one of the most tremendous psychological mistakes you can make. This is where they see other traders doing well and decide to get into the business as well. This trend became popular among traders during the coronavirus pandemic as cryptocurrencies and meme stocks surged. As this happened, media companies like Bloomberg, CNBC, and Business Insider started talking about how ordinary traders were making a fortune in the market. Other retail traders get into the industry just because they saw their friends or relatives make money in the market. As such, they move their money to the financial market without having a good understanding of how the industry works. Another way of FOMO in trading is when a trader will see a financial asset rising and decide to invest in it without doing some research about it. Reason 3. Endless strategy change. The next reason why more than 90% of all traders lose money in trading is that they endlessly change their strategies. This is common among new traders who are still learning about the industry. A good example is a trader who starts using technical indicators like moving averages and relative strength index, RSI. As they learn more about trading, the traders start changing their strategies. Reason 4. Unrealistic expectations about trading the stock market. Trading the stock market inherently involves some level of risk. Yet the majority of people attracted to the market are willing to take higher risks, believing they are adequately equipped to trade after reading a few books or attending a weekend course. Indeed, many traders seek out instant gratification, plunging headfirst into the stock market using complex strategies in the hope of profiting from their efforts. Sadly, many lose their hard-earned savings on unrealistic expectations. The streets are littered with wannabe traders, and in a bull market many are profitable mainly through sheer luck rather than good knowledge. Strong bull markets tend to hide mistakes in judgment and lack of knowledge, which is why I say that unless you have been trading the stock market successfully for more than 2 years, you cannot consider yourself a trader. Reason 5. Emotions overpower logical thinking. Hope. At first, you are hopeful you will make a ton of money, just like that one investment guru you saw on YouTube making millions of dollars by investing in no-name penny stocks or whatever else they are selling you through a course. You hear about so many success stories and think, what's to stop me from doing these same trades? Greed. So you start day trading and get greedy when you see your stock go up in value and think, how much more can it go up in value? This is just the beginning. If I just hold on to it a little bit longer, I'll have made tremendous profit. Fear. And then you're hit with fear. It's the fear of missing out on profits if you just held on to it a little bit longer than you should. It's the fear of losing money that causes you to sell the stock as soon as it goes down in value, even though it might just end up skyrocketing back up the next hour. The fear of loss is a much more powerful motivator than potential profit. This is why insurance companies always try to scare you into buying, and it works. Regret. Lastly, we have regret. This one I hear all the time: people regret buying a stock, people regret not buying a stock, selling too soon, not selling soon enough, etc. And then they think they won't make that mistake next time. These four emotions are going to seriously hinder your ability to make profits day trading. But that's not all. The biggest reason day traders lose money is the risk they take on. Day traders are more likely to make risky investments to reach for those higher potential returns, and as you can probably guess, high risk equals high potential loss. How to avoid these traps? Solution number 1. Train yourself properly. Therefore, we recommend that you take time before you start trading. A good place to start is to look and have a good understanding of the 5 key stages that traders go through. Knowing these stages will help cushion you from the challenge of losing money as you start your trading career. The next step to avoid losing money as a trader is to learn the details of trading. Some of the top concepts that you can use are: asset types. This is where you look at the various asset types in the market. The most popular asset types in day trading are currencies, cryptocurrencies, exchange-traded funds, ETFs, bonds, and stocks. Fundamental analysis. This is where you use news and economic events to determine the future direction of an asset. Technical analysis. This is where you use technical indicators like the moving average and the relative strength index, RSI, to predict the future direction of an asset. Price action analysis. This is where you use chart patterns like the ascending and descending triangle and head and shoulders to predict the future direction of an asset. Risk management. Here you will learn more about how to manage your risks in day trading. Money management. This is the study of how to use and allocate your money in the financial market. Strategy development. Most importantly, you will learn more about strategy development and how to create a trading plan. Solution number 2. Avoid FOMO in trading. You can avoid FOMO in trading by doing several things. First, ensure that you take time to learn the dynamics of the financial market, as we have described above. Second, always seek to understand the reasons why an asset's price is rising or falling before you jump in. Third, always protect your trades using a stop loss and a take profit. Solution number 3. Less is more. Stick to your trading plan. The bottom line is that traders must stick to a well-defined plan and trade that plan even when it is uncomfortable. The vast majority of the population, and thus the vast majority of traders, buckle under this uncomfortable pressure, the same way we reach for the chocolate bar instead of the carrots. Since most of the population is more than happy to join the crowd, by having discipline combined with a decent strategy, it is possible to be one of the few successful traders who doesn't take part in the crowd's losing ways. Day traders, swing traders, and investors can make great returns, but only if they adhere to a few concepts. You can avoid this by taking time to learn more about trading. As you do this, you should identify the best strategy based on your risk preference. After this, you should spend a lot of time on a demo account practicing. Doing this will help you master one method of trading and be good at it. Keep this in mind, it's better to master well and profit from 2/3 strategies than to use 10 and lose as much, or more, than you gain. The more strategies you use at once, the more complicated it is to manage them. It will also help you simplify your trading and help you identify trading opportunities while doing relatively easy things. For example, instead of using 10 indicators to find a signal, having a simple strategy will help you find signals using 1 or 2 indicators. Summary: 90% of traders lose money not because of the strategy they use or the mental challenges trading brings, they lose due to their lack of knowledge on how the market really works. It's the lack of knowledge of the way the market works coupled with the wrong definition of trends that makes people lose money, not the strategy/psychology/money management problems that only a minority of traders have. Trading is a process of continual discipline. We are only as good as our discipline. We can be a great trader one day, and piss poor the next if we stop following our plan. Many people think that once they become profitable, they can relax. Do you see professional athletes ease off once they make it to the NBA, NHL, or the PGA? No, they continue to work hard at what they do, or they fall by the wayside. The ones who last enjoy it, they enjoy the challenge and the competition. Those who love trading will put in hours without even thinking about it. Those who only trade to make a quick buck will never be able to compete with the person who loves it and immerses themselves in the process of learning and improving. Only trade if you really want to. Without that passion, you are at a huge disadvantage to the people who have it. Good luck on the journey. While I think it's important to explain things so people know what they are getting into, I am of course a trader myself. I started trading full-time in 2005, love it, and don't want to do anything else. I put in a lot of time to become profitable, and still put in a lot of time to maintain that performance and try to improve. I do believe that anyone with time, dedication, and some capital can be successful at trading. While most people will lose, as individuals we have a choice as to how hard we will work. There is lots of capital out there floating around, which we can learn to grab, but it won't happen by continually doing what the crowd does. So, why so serious?